Welcome to Educational Alpha. I'm Bill Kelly, CEO of COO Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, host Bill welcomes Cathy Marcus, co-CEO and head of U.S. equity at PGIM Real Estate. Cathy shares her extensive experience in the real estate sector, highlighting the evolution of the market, particularly in the context of the COVID-19 pandemic. The discussion covers the complexities of office space investments, the growing importance of ESG requirements, and the potential of data centers driven by advances in technology. Cathy also addresses the challenges and opportunities in democratizing real estate investments for retail investors, emphasizing the importance of understanding liquidity constraints and the need for robust investor education. Listen in.
Cathy Marcus, welcome to Educational Alpha.
Thank you.
Certainly, I want to acknowledge at the get-go the commitment you and PGIM have on educating the end investor, and most recently for us, it was demonstrated by your kind sponsorship, this micro-credential on our unified platform coming out in a few short days. So very much appreciate that. And any firm that invests in education up front should be commended for that. So thank you for that first and foremost.
You're welcome.
So maybe sticking to the script, so to speak, for this platform, maybe a little bit, Cathy, in your background. I think you've spent most of your career at PGIM, but maybe just bring us up to date to where you are today.
Sure. So I've been at PGIM for 25 years. I've been in real estate for a little over 35 years. I've worked all around the asset class in different roles, really very traditional start in analyst program. I was an undergraduate real estate major and a graduate real estate investment and development. So I've never done anything else. And since I've been at PGIM, I have also had a variety of roles, starting really in a single client account type role, and then in transactions. And then I spent really a very long stretch in portfolio management, running our flagship core open-end fund. And then I moved on to the operational side of the business to become our global COO about 10 years ago. Since then, also took on the head of our U.S. equity business, and now co-CEO globally.
Thanks for that overview. And Kaya and myself have done a lot with you and your colleagues, and you've also been a big sponsor of our alt series around the world. So we have had a lot of exposure to you folks and appreciate all you do. So given your background, Cathy, you're probably very well placed to comment on this. But maybe way back when at some point real estate was an asset class, it's become a very complex industry. And then perhaps a line of demarcation was COVID and what the retail market or the office market looked like before and after COVID, maybe two very different things as well. So maybe you could comment on what defines the real estate market today and perhaps where you're seeing opportunity as we think about a post-COVID world with the norms about back to work and even retail and where individuals want to live. And logistics comes into play as well. So I'll let you run with that.
Sure. So in terms of how to define real estate, it's obviously the built environment. It really depends on what your approach is. You can have really a direct investing approach, buying actual assets. And generally, people are buying real estate for income and then for capital appreciation. And you could participate as a lender. You could lend money into the real estate markets. You could participate in the public real estate markets, in the REIT market. You could participate in fixed income markets and commercial mortgage-backed securities or other asset-backed securities that are backed by real estate. So there's many, many different ways to play in the real estate market. And of course, I'm talking about institutional commercial investment, but of course, there's also the residential single family aspect and more of the mom and pop side of the business, which is actually still very prevalent in some of the sectors, including things that are more operational, like manufactured housing or self-storage, where while there's an increasing amount of institutional ownership, they're still fairly fractured in those parts of the market.
And coming out of the other side of COVID, just to pick on the office market, have the opportunities and risks of that market changed? And if so, how would you describe them in terms of both opportunity and risk as we sit here in 2024?
Clearly, coming out of COVID, I wouldn't say that the opportunities and risks or the investment thesis around office has changed suddenly after COVID. We had been in our firm underweight office, both as an equity investor and as a lender for many years. And if you look back at long-term performance in any of the direct real estate indices like a NCREIF property index, you will see that office was underperforming on a long-term basis before the pandemic. And what really changed with the pandemic was that there was now suddenly more angst around the demand side of the equation. And so I think really part of the reason for long-term office underperformance was more driven by supply, where if there was a lot of new supply, then of course rents would go down and there'd be lots of concessions. I think that the physical aspect of the office environment, people's attitudes around that and people's focus on it was changing before the pandemic. Before the pandemic, you were hearing a lot about, should we have an open office plan? Should we get rid of all the offices? Even pre-pandemic, especially the tech companies, they had ping pong tables and game rooms. So a lot of these trends were happening before the pandemic. To me, what really changed after the pandemic was the question around the demand side of the equation and the fact that the office went from a place of shelter and a place where you would go to do your work because you had to. Nobody questioned whether you had to show up at work every day pre-pandemic. And therefore, your average employer, and let's take the tech tenants out for a moment, the average employer didn't really have to do a lot to make their employees want to come to work. So why am I taking the tech tenants out? I mentioned just before that the tech tenants had already started to try to make their offices a place that would attract talent and where people could live their best lives and be there 24 hours a day and never leave to get food. Everything they needed was in the building. Well, that's because there was a war for talent in the tech sector. And that's what people do when they have to attract employees. So now fast forward post-pandemic, where employers are trying to get their employees to come back to the office. And just demanding that they do so wasn't really that effective because it was still very much of an employees market, if you will. There were labor shortages. And despite the pandemic coming out of that, there were many industries that were really growing. And so the labor force was really changing during that time. And companies realized, okay, we have to make the office better than home. We have to offer something to people that's going to be better than sitting at home at their home office that they've been sitting in for a year and a half. And so that's really another catalyst where the amount of capital that needed to be spent in order to renovate, upgrade, make office space modern and fit for purpose. Things like in our office, we have lots of Zoom rooms. Now, there were no Zoom rooms before the pandemic, but that's a necessity now. You have to have rooms where people can go and do Zoom and where there's good acoustics and where people can have some privacy and some quiet. So lots of things changed. And that just made the whole investment thesis around office that much more difficult to pencil because you already had a lot of capital investment, which is what led to a lot of that poor performance in office leading up to the pandemic. And then at the pandemic, now you have a whole change where more and more offices need to be renovated and upgraded and modernized. And at the same time, you have a ratcheting up of ESG requirements for offices in certain cities. I'm sitting in New York. New York is one of them, where there are citywide ESG requirements that you have to meet by a certain time period. And if you don't, you have to pay fines. And then there are cities like London where it isn't just that you have to pay a fine. You're not allowed to lease your building at some point if it doesn't have the right ESG requirements. So it's just a constant piling on of capital that needs to be invested in these office buildings at the same time that demand is lessening. So it's really a combination of changes that were occurring leading up to the pandemic and then the changes that occurred because of the pandemic.
So there are a couple of competing forces there, it sounds like, in terms of what the employee wants, what the ESG mandate is, the rehabbing of buildings. And if I think about maybe two opportunities that you may be looking at, one is the opportunity to buy a building at maybe a substantial discount in San Francisco that needs a tremendous reinvestment versus maybe starting in a greenfield project in a city like Austin or Nashville, where it might be easier to attract people, and maybe both have investment opportunities and theses behind them. Are you seeing both in play, the value in both situations?
I definitely think there's value in both situations, and particularly in Europe, the first scenario that you suggested, buying an existing very well located office building that needs to be upgraded, particularly around ESG. That is a strategy that we've been utilizing very successfully for the past couple of years in cities like Paris in particular, where you have very old office stock and a need for modern office stock. And there's still a lot of demand for office in a city like Paris. So now contrast that with San Francisco, where certainly it does start to seem like there might be some bargains in the office sector in San Francisco, but the demand side of the equation is still very much in question. And that is a difference I would point out between a city like Paris and San Francisco, is that there's still a question around demand. Now, in terms of new office construction, there's very little that is happening. And part of that is very difficult to get that financed. I can tell you that in a city like New York, there's almost zero vacancy in the brand new buildings. When I say brand new, I'm talking under 10 years old. I mean, there's just very, very little vacancy in that stock because there's so little of it.
And maybe just sticking with the tech theme, a different flavor though, generative AI, ChatGPT, this has been in the hearts, minds, and souls of virtually everybody, a little bit of the camel's nose in the tent in some parts of our industry, but everybody is talking about it. What has that done to the real estate sector in terms of logistics and the need for maybe a big warehouse, not to store Amazon material, but more for logistics? And how do you see that evolving as an investment opportunity?
For us, the main investment thesis that we're pursuing around AI and just tech in general is data centers. So we have very strong conviction about data centers globally, in particular, the format called hyperscale, which is the big ones where they tend to be single tenant buildings. And the big hyperscale tenants are the Microsofts, the Amazons, et cetera. Really, it's being driven not just by the evolution of AI, but also things like cloud computing in general. So that is definitely a growth sector. The demand for data centers is supposed to grow by a compound annual rate of about 18% over the next 5 years. And these things have to be built. They don't exist. And in order to build a data center of that scale, of the hyperscale type, you have to get power. And often power is really the limiting constraint on data center development versus the availability of land.
Most areas you see maybe go out to the West Coast for the wind farms, but you see these solar farms everywhere now. Is that part of real estate as you would define it, where you've got a big piece of land and it's just covered with solar panels?
It's a very interesting question. There is no dictionary definition of what is considered real estate, but the lines are definitely blurring. And there's this whole notion of, like I was just talking about data centers, we actually define that as digital infrastructure. But we have a digital infrastructure practice within a real estate business. There are some people who put their digital infrastructure only in an infrastructure business. So a data center is a building, so we consider it to be real estate, but it is digital infrastructure. And solar farms are sort of energy infrastructure, but they are on land, or they can be on the roof of industrial buildings. So there's definitely a blurring of the lines.
Okay, thanks, Cathy. So maybe in the remaining few minutes, maybe a pivot toward democratization. And most of us do not have a defined benefit plan, so we're looking for more uncorrelated risk premia. Real estate is a very interesting sector for investors to think about and to access. But first, maybe you could compare and contrast commercial real estate versus REIT. And then I want to talk about how we educate the investor and provide the best wrapper to do that.
Sure. So I'm going to probably use different terminology than you, but direct real estate, meaning I own a building or I own a portfolio of buildings, versus a REIT, whereas I own a share in a company that owns buildings. So one of them, direct real estate, is very illiquid. Let's say that I own an apartment project and I realize that I need cash. What do I do? So first I have to figure out how much my apartment building is worth, which it's an illiquid asset type. And I have to figure out what are the comparable sales, what are the yields that investors are requiring. It's not something I can just go to a Bloomberg terminal and say, what is my apartment project worth today? So that's a process. Then I have to hire a broker to sell my asset. I have to put together a lot of due diligence materials. I have to do all kinds of work on surveys and title, and I have to find a buyer, and then my buyer has to get a loan. And then maybe it takes, maybe all in from the time I decide I really want to sell my building until it's sold, it's 4 to 6 months. Okay. And that's not taking your time. It's very illiquid from that perspective. Versus if I own a basket of REIT stocks, I can sell them that day. And I am then essentially shifting the onus of liquidity onto the company that sponsors the REIT versus onto me. And that's really, I think, one of the big questions is, where does the burden of liquidity sit? And I've actually seen an evolution of that in the defined contribution space. So we have a defined contribution product. We have a couple that invest in direct real estate. And historically, there hasn't been a lot of direct real estate in defined contribution plans. I think we launched our product something like 15 years ago, and we were quite early to that game. And during that time, until very recently, investors and plan sponsors who would add these to their platform, add these products, they would require that there was a wrapper with a certain amount of liquidity. So maybe, as an example, sometimes we would hold 10% in REITs. So that's a liquidity valve. We would often have a line of credit that would be a liquidity valve. And increasingly, investors are telling us, we don't want your wrapper. We don't want to pay for the liquidity. We're going to define contribution product. We're going to go directly into the underlying fund and let us worry about the liquidity. So it's interesting that sometimes I think when people are new to an asset class, they're very, very nervous about liquidity. Then they start to see how it works. And then they realize they can solve for that in other ways in their portfolio, because you are paying for liquidity in a way.
So if they say, don't worry about it, we'll get it covered, what's an example of how a platform would be able to solve for it outside of what the product itself can offer?
So let's say that you're a pension plan. You don't have liquidity in some pocket of your portfolio, real estate, private equity. But that's why pension plans hold a lot of very liquid assets like stocks and bonds and cash. And a lot of times, especially a sophisticated institutional investor, they're very used to balancing liquidity needs, and they know where they can get liquidity quickly and where they can't. And by the way, their expectations of returns of those products differ. Where you have no liquidity, you have an expectation of higher returns. Where you have instant liquidity, you have less of an expectation.
But in a DC plan, that participant, the average person in the street, does not have that optionality. And maybe this is a good way to wrap this up and all the way back to the work that we're doing together with Unify is, I think an investor's coming in and they're in love with maybe the real estate proposition around diversification, but then they want liquidity to an asset class that was meant to be illiquid to harvest that value. And if they're looking for that, they might be better off in the REIT, but they say, no, I want what David Swenson has. I want to be able to get into the more viable long-term real estate investment. Have we done enough on the educational side? And does the end investor understand the concept of long-termism well enough? Because an interval fund can provide some liquidity, maybe not the perfect wrapper, but what are your views on the wrapper, on education, and where you see the future in terms of accessing this asset class to the very best advantage of the end investor?
I completely agree with you. If you need instant liquidity, you should be investing in public real estate securities. The problem is, and I think the argument that most people will make is that that's highly correlated often to the broader equities performance. So people are looking for something less correlated. And so direct real estate is very appealing. But it's just a fantasy that you can have that same level of liquidity with illiquid assets. You just can't. And you mentioned interval funds, and various wrappers can offer a certain percentage a month or a quarter, depending upon how they're structured. But you have to ask yourself, where's that money coming from? Because in the time frame that I just gave you for selling an asset, that's not a monthly kind of thing. Now you can try to plan ahead for that, and some people do it better than others. But I'm not an expert here, but my educated guess is that the end user is not educated enough about what these products are, because there's a million articles written about some of these household names sponsoring these funds. And at the end of the day, the funds are providing the level of liquidity that they said they would provide in the offering documents. The rules are very clearly laid out in all of these products in the same way that they are for institutional products that we run. The rules are very clear. People know what is possible from a liquidity standpoint. People know what the circumstances are when a fund will have to be gated, meaning nobody can take any money out. And it feels like the extreme rhetoric or whatever in the press about how terrible this is and what a big shock it is. I mean, it is terrible if you want your money and you can't get it, but it's not a surprise. Everyone knew this was a possibility. So maybe the fact is people didn't know, and they were not familiar enough with what they were buying. So I do think that as more sophisticated investment tools are available for individual investors, there is an onus on the intermediaries and on the end investors themselves of you have to do a lot more work than if you're going to buy an indexed ETF. If you're getting into something illiquid, you do need to do a bit more homework.
No, I agree with that. And while the press is not a fiduciary, they have responsibilities. And I think talking both sides of it, I've probably seen and read everything you have as well. And there's nothing wrong with these products. Everything has been fully disclosed. And I think there's two sides to it. The investors that want out and that liquidity desire might be misplaced relative to what they signed up for, versus the investors that stayed in and understood the product and may be suffering some form of performance degradation because other investors want liquidity. So we have some work to do as an industry, as a media. And if the goal is to have better outcomes for the end investor, I think the work we're doing together, COO with PGIM, is an absolute step in the right direction. We still have some wood to chop, Cathy, but appreciate your support, PGIM support, and we will continue to fight the good fight for the end investor.
Yeah, and I think it's really important for everyone to think about why these protections are in place. And the protections are in place, meaning the ability to gate a fund. It's not to punish people who want to take their money out. It's not to make it more difficult. It's to protect the investment of those who are staying in. It's a classic run on the bank scenario if you didn't have these protections. So I think it's important to focus on protecting the end investor.
Excellent way to end it. Cathy, thanks for the sponsorship, the support, and your time today.
Thank you.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the CAIA Association and subscribe to the show at caia.org. That's CAIA.org. See you next time.